I have learned that when everybody feels clever at the same time, the danger is usually larger than the opportunity. Most people think the great market shocks begin with a headline. Everybody can see a war, a bank failure, a recession call on television, a sudden crash in a well-known index. But the trouble that does the most damage usually begins in the plumbing. It begins in the trade people stop thinking about because it worked too well for too long. That is what I believe is happening when I look at the dollar. Now, the popular way to describe it is simple. A lot of people are short the dollar. Retail traders are short the dollar. Institutional investors are short the dollar. Hedge funds are short the dollar. Even large commercial players have leaned into the same broad idea. They borrowed confidence from a falling dollar and used that confidence to own risk. That is always how these things begin. Nobody says, I am building fragility into my portfolio. They say, I am being efficient. They say, I am rotating into growth. They say, I am positioning for easier policy. They say, I am taking advantage of global disinflation. They say many sophisticated things, but underneath the language, the trade is usually plain. If you expect the dollar to weaken, you can take more comfort in foreign currencies, foreign assets, commodities, high beta equities, leveraged positions, and every kind of risk asset that benefits when money becomes cheaper and fear becomes smaller. And when that trade gets crowded, people stop seeing it as a trade. They start seeing it as the normal state of the world. That is when it gets dangerous. I have spent a lifetime watching human beings confuse a favorable environment with personal brilliance. A rising tide is mistaken for permanent genius. Easy financing is mistaken for durable strength. A weak dollar is mistaken for proof that risk has become safe. Then one variable changes and what looked like a calm lake turns out to be a narrow bridge with too many trucks on it. That bridge, in my view, is the short dollar trade. If you want to understand why this matters, you do not need a complicated formula. You only need to understand what happens when people borrow one thing to buy another thing, and then the borrowed thing starts getting more expensive. The logic is ruthless. If you short the dollar and use that posture to own stocks or other risk assets, a rising dollar does not merely hurt your opinion. It attacks the funding leg of your position. Now you do not just dislike the move, you have to respond to it. And when enough people have to respond at the same time, markets stop behaving like neat academic models and begin behaving like crowded doorways. That is how forced buying in one asset creates forced selling somewhere else. The source material for this idea is not hidden. The setup is sitting in plain sight. The dollar has been moving near a zone where repeated selling showed up. And the argument is that if it pushes through that area, the people who spent months leaning against it will have to buy it back in a hurry. Felicite. Fay turn 4 file 4 Fay. That kind of move is not gradual in spirit. Even if the chart appears gradual at first, the market gives you a polite warning, then a hurried message, then a stampede. People who were calm at the lower levels become urgent at the breakout. People who told themselves they had time discover that time was the one thing they did not have. When I hear people say the dollar could jump toward 102, then 104, and beyond if the unwind accelerates, I do not hear a target. I hear a chain reaction. Fay file site Fay turn 4 file 2 Fay, because the dollar is not rising in isolation. It is rising against a backdrop that matters enormously. Oil is part of the story. Europe is part of the story. The euro is part of the story. Central bank expectations are part of the story. And the stock market, which likes easy money and abundant optimism, is tied to all of it. That is why this is bigger than a currency call. When oil prices stay high, Europe feels it more acutely than many investors like to admit. An economy that depends heavily on energy imports carries a built-in vulnerability. When energy costs rise, the trade balance comes under pressure. Growth weakens. Households feel poorer. Industry loses breathing room and the currency pays a price. That is the core of the euro problem in this setup. The argument is not merely that oil is high. The argument is that high energy costs hit a weak Eurozone economy at exactly the wrong time, which makes the euro more fragile and the dollar more dangerous to bet against. Fay file site Fay turn 4 file 0, Fay turn 4 file 1 Fay. Once you see that, the rest of the puzzle starts coming together. Many investors had convinced themselves that the Federal Reserve would cut rates, that Europe would find some footing, and that the broad path of least resistance for the dollar was lower. That view gave people permission to keep stretching into risk. But if the Fed does not cut, or if the market has to push those cuts further out, the emotional foundation of that trade cracks. The source document says exactly that. It argues that support for the dollar is strengthening because expectations for Fed easing are being pared back. While the European side of the equation is becoming more vulnerable, Fei follow-site Fei turn 4 file 1 Fei turn 4 file 2 Fei. That is not a minor adjustment. That is the sort of adjustment that turns a popular trade from comfortable to crowded. And crowded trades do not require every participant to panic. They only require enough participants to recognize that the exit is smaller than they assumed. When I look at markets in moments like this, I do not ask a heroic question. I do not ask where the perfect bottom will be. I do not ask which candle is the one that matters. I ask a simpler question. What are people most likely to be forced to do if they are wrong? That question has made me a lot more money than glamour ever did. If the short dollar crowd is wrong, they do not get to simply shrug and hold forever. They have to buy dollars back. And if they have to buy dollars back, they often have to sell the assets they bought with that posture. That is where equities enter the story. The source material makes the correlation point directly. As the dollar moved down, stocks rallied. As the dollar surged, the SP 500 tended to wobble or pull back. Fei follow-site Fei turn 4 file 4 Fei. That does not mean every tick in the dollar mechanically creates every tick in equities. Markets are never that tidy. But it does tell you where the pressure is likely to show up first when the funding environment changes. A strong dollar is often a tightening event. Whether or not the headlines use that phrase, it makes leverage less friendly. It punishes assumptions built on easy global liquidity. It exposes the difference between investors who own assets and investors who borrowed their conviction. I have no interest in borrowed conviction. Borrowed conviction looks strong right up until the bill arrives. Then it looks like panic. That is why I always come back to the structure of a trade. The great hidden enemy of many portfolios is not the asset they bought, it is the invisible dependency underneath it. Maybe they needed low rates, maybe they needed a weak dollar, maybe they needed cheap energy, maybe they needed expanding multiples, maybe they needed all of them at the same time. If a portfolio needs too many favorable conditions at once, it is not a sturdy portfolio. It is a fair weather machine. And fair weather machines fail exactly when people most need reliability. The more I studied business over the years, the more I learned that fragility often wears the costume of sophistication. A simple structure with real staying power is less exciting on the way up. But it is often the only thing left standing when everybody else begins liquidating. That matters here because the source is not merely describing a currency chart, it is describing a full market unwind. Institutional investors were said to be moving flows in a more defensive direction. Speculators had already reduced bets against the dollar sharply. Asset managers had been cutting futures exposure and selling risk. Fei file site Fei turn 4 file 3 Fei turn 4 file 4 Fei. Those details matter because they show a shift in behavior before the crowd fully admits the narrative has changed. The tape often changes before the consensus note changes. That is another lesson I have never forgotten. By the time a view becomes respectable, the easy money in that view is usually gone. So when I see institutional managers trimming longs, when I see dollar skepticism fading, and when I see energy acting like a wedge in the global system, I do not call it noise. I call it preparation. The market rarely sends engraved invitations before it revalues risk. It sends clues. A correlation weakens here. A crowded bet loosens there. A policy expectation gets pushed out. A vulnerable region loses more pricing power. An asset people mocked begins rising. Then suddenly the public says the move came out of nowhere. It never comes out of nowhere, it comes out of places people did not respect while the environment felt easy. I also want to say something about inflation because people often misunderstand the shape of that problem. The source text argues that rising energy can create a short-term inflation impulse, but not necessarily a lasting one when wages and consumer capacity are not keeping pace. Fei file site Fei turn 4 file 1 Fei. That distinction is important. A burst of higher prices does not automatically create a healthy economy. In fact, it can do the opposite. It can make households poorer in real terms. It can pinch margins. It can scare central banks without creating real prosperity. That is a miserable combination. You end up with discomfort, not durable growth. You end up with anxiety, not strength. And when that happens, markets can get caught between two unhappy truths. The economy is too weak for optimism. The inflation pressure is too real for easy rescue. That is why so many investors misread late cycle environments. They think pain automatically means immediate central bank salvation. Sometimes the pain arrives before the rescue. Sometimes the rescue is delayed. Sometimes the rescue shows up only after assets have already repriced. That gap between expectation and reality is where forced unwinds live. The euro side of this issue deserves extra attention. The source argues that the euro had support because some traders expected the European Central Bank to lean more hawkish, even while the Fed was expected to cut. But if energy pressure keeps worsening and the ECB cannot satisfy those hawkish hopes, the euro weakens harder and the dollar rises faster. Fay file a site Fay turn 4 file 1, Fay turn 4 file 2 Fay. That is not some exotic corner case. That is a straightforward repricing of relative confidence. Currencies are, in many ways, a referendum on comparative stress if Europe looks weaker. If energy hurts Europe more, if the ECB disappoints relative to expectation, if the Fed stays firmer than people hoped, then the short dollar crowd suddenly has a much uglier arithmetic problem than it had a month earlier. I have watched arithmetic humble more people than ideology ever has. You can argue with opinions. You cannot negotiate with margin, and even when there is no explicit margin call, the portfolio logic acts the same way. A manager who is wrong on the funding leg, wrong on policy timing, and wrong on regional weakness does not need an official notice to begin selling. He sells because preserving survival becomes more important than preserving elegance. That is how market tone changes. That is how narratives break. That is how yesterday's consensus becomes tomorrow's explanation for damage. The source also ties in the Strategic Petroleum Reserve release and makes a subtle point that I think many people will miss if they read too quickly. The release is not treated as proof that oil pressure disappears tomorrow. It is described as slow, partial, and structured in a way that still leaves near-term upward pressure in place, while hinting that prices may be lower by the time borrowed barrels are repaid. Fay file a site Fay turn 4 file 2 Fay that matters, because markets live on timing. A long-term expectation for lower oil does not help a vulnerable economy being squeezed right now. A promise of future relief does not eliminate present stress. Businesses can fail while waiting for conditions that may improve later. Portfolios can be cut apart while waiting for a thesis that eventually becomes true. That is another investment lesson people learn too slowly. Being eventually right is not the same as surviving the path. So when I think through this environment, I do not build my thinking around ideal outcomes. I build it around pressure points. Which region is more exposed to energy? Which trade became too crowded? Which assumption about rate cuts is being challenged? Which assets were supported by a weak dollar? Which holders of risk are likely to de-risk first? Those questions do not make for glamorous television, but they make for sound capital allocation. And capital allocation is the only game that matters if your aim is to survive and compound. Now let me say something a little unfashionable. When a market becomes obsessed with upside targets, I prefer to think in terms of balance sheet stamina. Can you own what you own if the dollar rises harder than you expect? Can you own what you own if Europe weakens faster than you expect? Can you own what you own if oil stays high longer than you expect? Can you own what you own if the Fed does less than you expect? Can you own what you own if equities do not give you a quick escape rally? If the answer to those questions is no, then your issue is not prediction. Your issue is structure. The source text becomes very direct near the end. It says long-term investors may need to cut exposure back and hedge some of that risk with dollar strength, because a rising dollar can unwind a great many other positions. Faithful site Fay turn 4 file 2 Fay. That is not a call to become theatrical. It is a call to become honest. A lot of investors would rather invent confidence than reduce exposure. They would rather explain why the market is wrong than admit the setup changed. They would rather cling to a crowded trade than take a smaller position and keep their options open. I have never seen pride improve an investment result. Humility does that. Liquidity does that. A willingness to look foolish early often prevents you from becoming ruined later. If I were describing the core risk in plain language, I would put it this way. Too many people got used to a world where the dollar was the easy short, policy easing was the coming gift, and equities were the natural place to hide. Now oil is threatening that comfort. Europe is magnifying that discomfort. The Fed is no longer the rescuer many hoped for, and the dollar is beginning to act like the asset that punishes consensus. That combination can produce much more damage than investors expect, precisely because each piece reinforces the others. A higher dollar pressures the trades financed against it. Selling in risk assets feeds fear. Fear creates more demand for safety. Safety flows back into the dollar. A weaker euro worsens the relative move. Disappointed rate cut hopes remove the cushion, and what looked like an ordinary correction begins to feel like an unwind. That is why the source keeps returning to the idea of a devastating impact. Not because every forecast word must be dramatic, but because crowding plus leverage plus funding stress can create outsized consequences. Fay file site Fay turn 4 file 0 Fay turn 4 file 4 Fay. Now I want to add the Buffett part of this, because I do not want to speak like a trader staring at a screen for every heartbeat of the day. My temperament has never been built around predicting every short-term move, but I have always respected conditions that can force bad behavior. That is an investment question too. If market participants are positioned in a way that can compel liquidation, that matters to owners of businesses whether they trade frequently or not. A great business can see its stock marked down in a dollar squeeze. A sound balance sheet can get sold alongside fragile ones. An index can fall for reasons that have nothing to do with the long-term earning power of every company inside it. So the practical task is not to outscream the market, it is to know what kind of owner you are. If you are a trader, you are dealing with the immediate velocity of the move. If you are a long-term investor, you are dealing with the price at which fear may temporarily offer you good assets or expose your weak ones. But in both cases, denial is expensive. If your portfolio is built on the assumption that the dollar must weaken, rates must fall quickly, energy will behave. Europe will stabilize and risk appetite will remain generous. Then you have given yourself too many ways to be hurt at once. I prefer fewer dependencies. I prefer businesses that can live through discomfort. I prefer cash and flexibility when other people treat them as old-fashioned. I prefer stepping away from consensus when consensus starts sounding like a lullaby. That does not mean I become reckless in the opposite direction. It means I respect the asymmetry. A crowded short can move faster than people believe. A funding unwind can overwhelm fundamentals for a while. A safety trade can become self-reinforcing. And a market that assumed help was coming can become violent when that help is delayed. The text also references historical episodes where spikes in energy preceded major corrections, recessions, or financial stress. Fay file site Fay turn 4 file 3 Fay. I never rely on history as a script. History does not repeat on command. But it does rhyme often enough to be useful. Energy shocks have a way of revealing which systems were healthy and which systems were merely lubricated by ease. Cheap inputs cover many sins. Expensive inputs reveal them. Easy money covers many weak ideas. Tighter money reveals them. A weak dollar can flatter many risk positions. A strong dollar tests them. That is what I believe the market is approaching now, a test. Not every business will fail that test. Not every asset will collapse. Not every forecast of doom deserves attention. But a test does not need universal destruction to matter. It only needs enough forced repositioning to change price, confidence, and opportunity. I do not try to impress myself by pretending certainty. I do not know the exact day this pressure resolves. I do not know the exact level of every index on every week ahead. But I know what a vulnerable setup looks like. And I know that when a market starts relying on a short dollar consensus, delayed rate cuts, euro resilience, and calm energy pricing all at once, the burden of proof belongs to the optimist. The final thing I want to say is about behavior. There are seasons when intelligence helps less than discipline. This is one of them. When people feel pressure, they begin reaching for narratives that restore comfort. They say the move is overdone. They say the market will bounce because it always does. They say central banks will save them. They say oil will fix itself. They say Europe cannot get worse. They say the dollar has risen enough. Maybe one of those things will eventually be true. But investing is not a religion of maybe. It is a discipline of consequence. You do not get paid for how soothing your explanation sounds. You get paid for how well your structure survives. So if I were sitting with my own capital and thinking through this exact setup, I would not be hunting for reasons to stay maximally exposed. I would be asking where my hidden short dollar dependencies live. I would be examining which positions implicitly need a weaker greenback, easier policy, stronger Europe, and quiet energy markets. I would be trimming what depends on too many favorable conditions. I would be protecting liquidity. I would be patient with the idea that better opportunities are often born when crowded trades break apart. That is how I have always tried to think. You do not have to catch every move. You do not have to prove you were first. You do not have to win an argument with the crowd. You only have to keep your capital, avoid forced errors, and act when the odds are finally in your favor. A short dollar unwind is not just a currency event. It is a stress event. It is a reminder that what people borrow to feel confident can become the source of their fear. It is a reminder that policy hopes are not policy actions. It is a reminder that energy can break sentiment long before it breaks the headlines. It is a reminder that Europe and the euro matter far more to the dollar story than many casual investors realize. It is a reminder that when a trade becomes universal, it is already old. And above all, it is a reminder that markets do not punish consensus, because consensus is immoral. They punish it because crowding destroys room to maneuver. That is why I do not treat this setup lightly. If the dollar keeps pressing higher, if the euro keeps weakening, if the Fed disappoints the easing camp, and if oil keeps leaning on an already fragile global backdrop, then the unwind people have dismissed as a possibility can become the event that reprices everything else. At that point, the most valuable asset in the room will not be confidence. It will be preparedness. Preparedness to own less when less should be owned. Preparedness to hold cash when cash becomes scarce. Preparedness to watch forced sellers without joining them. Preparedness to distinguish between businesses that merely erode liquidity and businesses that can compound through adversity. That has always been the heart of intelligent investing. Not excitement, not style, not perfect timing structure, patience. And the refusal to confuse a popular trade with a permanent truth.